How does a $200 million fund reshape multifamily and industrial assets in the Midwest? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In a bold move that could significantly impact the commercial real estate landscape, Minneapolis-based Enclave has launched a $200 million investment fund. The Real Income Plus Fund is designed to expand access to alternative real estate investments while offering substantial tax advantages and mitigated risks for investors. This core, open-ended fund focuses on stabilized multifamily assets in the Midwest and Mountain West, as well as industrial assets nationwide. Josh Wilcox, President of Development and Investments at Enclave, described this fund as a historic advancement in Enclave's mission to redefine private real estate investment. By combining disciplined acquisition practices with innovative tax-advantaged structures, Enclave is opening doors for investors to participate in high-value, risk-conscious opportunities that were previously inaccessible. To support this strategic initiative, Enclave has brought on Dan Ruel, a seasoned real estate veteran, to oversee acquisition strategy and portfolio growth. Ruel will be instrumental in guiding investment selection, capital deployment, and partnership development. The global automotive retail sector is undergoing a significant transformation, driven by the shift toward electric vehicles, changing consumer expectations, and evolving dealership formats. This is according to CBRE's latest report, What's Happening and What's Next in Automotive Retail Real Estate. The report highlights how automakers and dealers are rethinking traditional retail models to align with new mobility trends and sustainability goals. This evolution is redefining the way automotive real estate is designed, developed, and utilized, from urban showrooms to service hubs and last-mile logistics centers. The rapid adoption of electric vehicles has sparked innovation in how vehicles are marketed and serviced. With electric vehicles requiring less routine maintenance, dealerships are downsizing service areas and placing greater emphasis on digital-first showrooms and customer experience centers. A representative from CBRE mentioned that the traditional auto dealership is being reimagined into a lifestyle hub, a space where technology, sustainability, and community engagement converge. This shift presents a unique opportunity for property owners and investors to adapt their portfolios to the electric era. In major cities, original equipment manufacturers are moving closer to customers through smaller urban stores, pop-up galleries, and experience centers located in high-traffic retail areas. CBRE's analysis shows that these urban formats allow automakers to reach tech-savvy, sustainability-conscious consumers directly, often blending online sales with in-person brand experiences. At the same time, suburban and highway-based facilities are being reconfigured to support test drives, vehicle delivery, and electric vehicle servicing. Flexibility and location efficiency are now critical factors in automotive real estate development. Sustainability is now a core aspect of automotive retail. Electric vehicle infrastructure, including fast-charging networks, rooftop solar systems, and energy-efficient designs, is becoming a standard feature in new developments. Many dealers and investors are incorporating green certifications and carbon reduction measures to future-proof assets against evolving environmental, social, and governance regulations. CBRE expects investor interest in automotive real estate to remain strong, particularly in markets with rising electric vehicle penetration and supportive government policies. Properties with electric vehicle-ready infrastructure and adaptive reuse potential are attracting institutional capital, with investors viewing them as hybrid assets, combining retail, logistics, and mobility functions. The transformation of automotive real estate reflects a broader convergence of mobility and property innovation, and forward-looking investors are already positioning themselves at the intersection of these two fast-moving industries. Chicago area warehouse developers are seeing a resurgence in leasing activity as vacancy rates approach record lows, according to a report by Danny Ecker from Crane's Chicago Business. After a 2-year period marked by elevated interest rates and a cooling off from the pandemic-era leasing frenzy, the market is showing signs of heating up once more. A significant recent development includes Pepsi Beverages signing a lease for over 350,000 square feet at the logistics campus in Glenview. This industrial park is currently under construction on what was formerly the Allstate corporate campus. Such substantial leasing activity indicates a renewed confidence among developers and tenants in the Chicago market. This uptick in leasing activity in the Chicago area provides an interesting contrast to the industrial real estate scene in Kitchener, Waterloo, London, and Cambridge, Ontario. In these Canadian cities, the industrial market has also been experiencing low vacancy rates, driven by the growing demand for logistics spaces and distribution centers. However, local developers have faced challenges due to limited land availability and regulatory hurdles, which have slowed down new construction projects. In the United States, particularly in Chicago, the availability of larger parcels of land and a robust infrastructure network have facilitated more aggressive development strategies. This has allowed developers to respond more quickly to shifts in demand compared to their Canadian counterparts. The ability to secure significant leases, such as the one by Pepsi Beverages, underscores the strategic advantage of having ample developable land and supportive logistics infrastructure. Jacksonville's office market is presenting a complex picture, according to Leah Foreman from the Jacksonville Business Journal. While suburban corridors are experiencing a surge in leasing activity, downtown Jacksonville is struggling with a significant 28% vacancy rate. This divergence highlights the shifting dynamics within the city's office leasing landscape. Suburban areas are leading the charge in office leasing, driven by a demand for more flexible and accessible workspaces. Companies are increasingly opting for locations that offer convenience and proximity to residential neighborhoods, reflecting broader trends in remote and hybrid work models. This movement towards suburban office spaces is reshaping the traditional understanding of office location priorities. In contrast, downtown Jacksonville is facing challenges with high vacancy rates, which can be attributed to changing work patterns and a slow recovery in urban office demand post-pandemic. The struggle to attract tenants downtown underscores the need for adaptive strategies that could revitalize these urban areas and make them more appealing in the current market environment. This trend in Jacksonville can be juxtaposed with office leasing activity in Kitchener, Waterloo, London, and Cambridge, Ontario, where suburban office spaces are also gaining traction. In these Canadian cities, businesses are similarly seeking locations that offer a balance between urban amenities and suburban convenience. The cross-border relevance of these trends highlights a shared evolution in office space preferences, driven by the global shift towards more flexible work arrangements. In the world of commercial real estate, change is a constant, and that's certainly the case for Birkdale Village in Huntersville, North Carolina. Recently, this mixed-use development has changed hands again, marking its second ownership transition in just over a year. The Charlotte Business Journal's senior staff writer Jennifer Thomas reports on this significant acquisition by a real estate giant. Known for its vibrant blend of retail, dining, and residential spaces, Birkdale Village has long been a cornerstone of the Huntersville community. The development's appeal lies in its ability to offer a walkable lifestyle with a suburban twist, attracting both residents and visitors alike. This latest change in ownership underscores the ongoing interest in mixed-use developments that cater to evolving consumer preferences and lifestyle trends. The new owner, a prominent player in the real estate sector, aims to continue the legacy of Birkdale Village while exploring opportunities for enhancement and expansion. As the demand for integrated living and retail environments grows, such developments are becoming increasingly attractive to investors who see potential in creating dynamic community hubs. This acquisition reflects broader trends in commercial real estate, where mixed-use properties are gaining traction due to their ability to adapt to various market demands. As more cities and towns embrace the concept of live workplace spaces, developments like Birkdale Village are setting the standard for future projects. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.